Thank you, dear friends and organizers, for inviting me to Ukraine and to speak at this conference. The reason I came here because I'd heard so much about Ukraine, and it has been mentioned in the press for the last 2-3 years. It was curiosity which drew me to Ukraine. And I have spent a little bit of time looking around Ukraine, looking around Kyiv. I went to the Maidan, which was quite a poignant shock for me to see so many young people die because of some stupidities. But it was very nice to go to the monastery and to the church. So I had a mix of both love and forgiveness, I must say. I feel I have lived many lives in one life. So I trained as a surgeon, then I did my master's in management, and have now been running a few businesses for the last few years. I thought I'll give you a little bit of background about the family because that would give you some insight into why I have come to Ukraine as well. So, do I press this or do I press this for this? Okay. So the family is an entrepreneurial business family. We have been in business in India for the last 300 years, and we are a major player in the economy of India. So we have a large business in infrastructure, financial services. We're the largest infrastructure non-banking finance corporation in India. We have ports, telecom, power projects. But the thing which has always been the core of all our businesses is to run our businesses with a lot of ethics. My father runs an annual conference on humanity, power, and spirituality every year, and you're all very welcome to come if you want to attend it. And this is again to promote well-being on the planet and to bring people together. So the different businesses that we are operating, I just gave you an idea. We have Shrey, the infrastructure finance company. We have a power company. We have we had the largest telecom tower business in India, which was sold to American Towers. We do construction. And Advenia is a healthcare business, which I set up in London about 15 years back to sponsor my PhD and to fund my PhD in liver transplantation. And that now employs about 5,000 people in the UK. And we are one of the top 5 providers of private dementia care in the country with 3,500 beds. So these are the different types of projects that we fund in India. IPCL is, we have a thermal power capacity of 8,000 megawatts, which we have installed in India. Then I mentioned to you about Shrishti, which is our construction company. We have done townships, retail malls, parks, various plazas in India. This is our healthcare business in the UK with 3,300 beds. And I've also built a 400-bed multi-speciality hospital in Mumbai, and this will get commissioned by January of 2019. And here am I speaking to you about banking crisis. It's only in the last 4 years, 4.5 years now, that I have learned about banking. We acquired the Austrian part of the Hypo Alpe Adria Bank from the Austrian Republic in the beginning of 2014. When we acquired the bank had very low risk management capabilities. The governance was very poor. The management team was not very strong. And in the last 4.5 years, we have transformed the bank into one of the best rated risk banks in Austria with the best governance. All our capital add-ons were removed by the FMA, by the regulator, and we have been given a green signal on almost every risk rating that we have. So our whole philosophy is to make sure that a bank is stable, its risk, governance, and management teams are very strong. And unless you have a stable platform, you cannot grow the bank. So when I started to look at financial crisis, I realized that financial crisis is not new to the banking industry or to the financial services industry. Financial crisis has been going on since the inception of financial markets over the last 250 years. And every time a financial crisis happens, there has been a knee-jerk reaction by the regulator, by the government. And every time a financial crisis has happened, usually it is one person who has been responsible for creating the crisis. And just looking at the history is very interesting. Most of these people have been English people, Britishers. 90% of them have been Britishers. There have been many crises in the last 250 years, but there are 5 major financial crises. And why I want to speak to you about this is because there's a lot of interesting lessons to learn. And we find that many of these lessons have been repeated in these 5, many of these same issues have been repeated in each of these crises. So the first major financial crisis occurred in 1792. And this was the responsibility of a villain, Willem Duer. He's a British guy. He was born in Devon and educated at Eton, where most of the kings and princes go in the United Kingdom. At that time, there were lots of new banks which were coming up in the United Kingdom, in the United States, and credit was really expanding. So people thought that banks are going to be profitable because a lot of loans were being written. And what William Duer did, because there wasn't a properly established stock exchange, he started to buy the shares of these banks, borrowing money from the bank to buy their own shares. You see, so suddenly, when he could not repay the banks and there was no liquidity in the marketplace, the whole stock market crashed. And that led to the panic of 1792. That was the first major financial crisis that happened, and this led to the formation of the first stock exchanges. So again, this was a knee-jerk reaction by the regulator and the government. They did not think before selling shares that a stock exchange need to be created, a market needs to be created to ensure liquidity and governance. The second major crisis happened, and this was again created by a British guy, and he managed to create a small country in Latin America, a false country, because everyone was focusing on the emerging markets, and everyone thought that Latin America is the emerging market in the 1800s, and it will make everyone very rich. So this guy created a small country called Poyas, and he started to sell the bonds of this country to all the major banks. And most of the major banks bought these bonds, and it was again not regulated. There was no central bank to monitor the quality of the assets, the quality of the bonds. There were no rating agencies. And when it transpired that there wasn't really any country, it was just a false country, and this guy had sold all these bonds to all these major banks. It led to a big crisis, which was known as the Latin American crisis. And after this, the first central bank was created to make sure that the asset qualities are being reviewed. But have we learned the lesson? Did we learn all our lessons? No. Again, another 30 years later, we had the railroad crisis, which is extremely well known. So railroads were expanding throughout the United States of America. People thought railroads are going to be profitable. Everyone started to buy stocks in the railroads. This particular gentleman, Edwin Ludlow, he used his own insurance company and bank's assets to buy the stocks in railroads. And he also borrowed from the banks to buy the stocks in railroads. The railroad profitability was not as high as their valuations. And when the stock market started to crash, he wasn't able to pay back. This resulted in a big global panic. There were 135 bankruptcies in 3 months. In the United Kingdom, the army had to be called because the valuations of these railroad companies did not match with their inherent profitability. So the lesson from this is that we have to look at the fundamental profitability of a business before investing in it or even buying stocks. The mere speculation will always lead to a crash. As a result of this, the central banks created cash buffers for all the banks. So the cash buffers came as a result of another crisis. It was a knee-jerk reaction or a regulatory burden imposed on the banks as a result of a major crisis. But again, did we learn our lesson? Let's see what happened. In 1907, there were many small banks. There were many small trust banks as well. And 2 villains, Heinz and Moos, I think they were Germans from their names, they started to buy one small bank after another. And they used the equity of one bank to buy another bank. So you suddenly had a huge leverage in the banking system where one bank was being bought with the equity of another bank. And finally, when they were not able to make the repayments, this led to another crash. And then the central banks, they were given the mandate to start regulating these small and highly leveraged banks. Before that, the central banks were not bothered about the small banks. They were only regulating the bigger banks. So the smaller banks came into the purvey of the central banks after this crisis. We all know about the Great Crash, the Great Depression of 1929. This was another Britain. So we've already seen that out of the 5 crashes that has happened, 4 of them were due to the Britishers. So what this guy did was, in 1929, the stock market was doing extremely well. So the banks were raising interest rates continuously to cool down the markets. And he was not able to make the payments from his company. So he forged share certificates, used it as collateral to borrow money from the banks. And because he had made a huge loan from the banks, which he was not able to repay, his crash resulted in the Great Depression. And a lot of people lost money. The small retailers lost, the retail deposits were completely wiped out. And this was the first time that the deposit protection insurance scheme was created to protect the small retail depositors. We all know about the most recent crisis. The most recent crisis, sorry, there was one slide missing. Okay, I think this part of the slide is missing. So this is about the subprime crisis that happened in 2008. In the subprime crisis, it wasn't an individual who created this crisis, it was an institution which created crisis. But again, behind institutions, you have individuals, and individuals have their own incentives. And because the performance incentives in banks were so high against just performing, against just writing loans, against just creating securities, mortgage-backed securities were created. They were mortgage-backed securities by themselves are good quality asset instruments and which has been used throughout Europe for a long time. But when you take one certificate and you start to issue more certificates against it, till the time that the actual asset which the certificate represents is now leveraged 10, 20 times, the value of that asset completely is wiped out. And that is what happened in the subprime crisis, because there were so many certificates being written against the original asset. And Lehman was the culprit. And the way the bank performances were managed was responsible for it. Again, the regulator has given a knee-jerk reaction. He said large banks are very risky and is trying to break the larger banks up. So what is the answer and what is our learnings from all these things in banking? Today we see that regulation has really tightened up. There's Basel III, Basel IV, which is going to come in. Capital ratios are being increased. There's a deposit protection insurance schemes in place. So what can we as bankers or people who are involved in the financial services learn from all these crises? It is to focus on the basics. Once we start to focus on the basics of any business, we start to create winning formulas. And what is the basics in any business? In any business, the first basic is you focus on good service, because through good service, you retain good quality customers. It is very important, every organization should manage their cost. I don't call it cost management, I call it waste management. See, whenever you are spending money which is not necessary, you're wasting the resources of your organization, you see. And once you waste the resources of your organization, you need to manage it properly. And you need to cultivate that culture in the organization. You have to explain to your employees that you have to manage waste. It is not cost cutting we are talking about. If you can preserve the organization's resources and utilize it properly, then you can create organizational growth. We can give you better incentives, we can give you better salaries, we can give you better bonuses. And that is a mindset one needs to develop in the business. The third thing, as bankers, it is very important that risk is managed well. We are, after all, managing and we are custodians of other people's wealth. So when people come to the bank and they put their money, a small person, he puts his life savings in the bank, he's entrusting you with that $10,000 or $2,000. His whole family's future is dependent on that. And if you don't manage that risk in the bank very well, and we lose his money, we create insecurity in his family. We just destroy that whole family. And if we think that we can destroy so many families who are dependent upon us, we start to have a different mindset. The fourth thing which I say to people is that net interest margins are very important. Banks are already highly leveraged by their own nature. Most banks are 20 times leveraged because the core equity tier 1 ratios in most banks is between 5 to 6%. So we are already leveraged by the nature of the business. And if we don't become profitable, if we are not profitable, then the net interest margins that we charge our borrowers is not right. Then we start to deplete the resources within the bank. And every organization has the responsibility to create its own resource base. I like to tell the story of this very rich man who goes to the bank in his Rolls Royce. He goes to the banker and he says, "Can I borrow $20,000 against my Rolls Royce? I need it for 2 months." And he's got all the paperwork, etc. The banker is delighted. He's getting the security of the Rolls Royce. All the paperwork looks absolutely right. And he says, "Fantastic, okay, here's 2% margin, and I'll keep your Rolls Royce." After 2 months, this guy comes back, pays the 2% margin, which is roughly, say, $400, takes the key of his Rolls Royce, and is about to drive back. So the banker asks him that you are such a wealthy person, why did you want to borrow money against your Rolls Royce? So he said, "Where else can I find a parking place so cheap and so secure?" You see, so I like to tell this story because it is very important that we focus on net interest margins as well. It is very important for banks to be profitable. So can we predict the next crisis to happen in banking? I think there will be a crisis in banking. The next crisis in banking may not happen in the next 10, 20 years, but it is bound to happen in the next 30, 40 years. And what is the reason behind this? What are the predictors of the next banking crisis? If you see, there are just too many banks at the moment. All the banks are competing for very low margin businesses. You see, the average margin in Europe is between 1.5% to 3%. At 1.5% to 3%, you cannot create enough profitable reserves on your balance sheet, you see. And if you go out to the equity markets to take equity into a bank, unless you're giving a return on equity of 15 to 18%, equity investors are not interested. So then what do? You leverage the bank even more to meet the capital requirements of the regulator. This is going to create a self-perpetuating vicious cycle. That is number one. So how can we stop this self-perpetuating cycle? The only way to stop it, in my belief, is that there should be a floor and ceiling to the net interest margins, which each bank is allowed to charge. So every bank should be said that, okay, you have to charge a minimum of 2.5% so that you level the competitive flow. And there should be a ceiling as well. Because if the banks start to charge too much, then you start to underwrite high risk loans. So if there's a floor and a ceiling, then you are making sure that all the banks are working within a particular bandwidth. Then banks will start to survive. Larger banks, just to underwrite or take away business, will not do low margin businesses because ultimately they're also creating a vicious cycle for themselves. So I think that is something for the regulator to think about. The second thing which I think is all the fintech businesses. There are many fintech businesses. Fintech is absolutely essential in today's marketplace. So please don't get me wrong. Technology is important to reduce your costs, to improve efficiency, to optimize your processes, but the technologies are not being controlled. There's no regulation behind the technologies. If you look at the fintech businesses, many of them are being started on the basis of algorithms which people say are sound. But there's no audit of the algorithms. Who are creating these algorithms? What are these algorithms? What is the formulas behind these algorithms? What is the thinking behind these algorithms? So these algorithms are only as good as the people who create them. So unless you can vet the algorithms, unless you can audit the algorithms, you are going to create a problem. So it is very important that the fintech should be regulated before another crisis happens and there's another knee-jerk reaction by the regulator. So these are the key messages which I wanted to give through this story of the different financial crises that has happened through history. Thank you once again for giving me an opportunity to present here, and very welcome to any questions. Thank you.